Good afternoon, traders and investors. Will back here with another one, coming to you with a Friday market recap. Hope everybody had a beautiful week of trading. So in today's markets, guys, we got another bad data set pertaining to inflation. Inflation on the producer side coming in a little bit hotter than expected. So is it all that bad for the markets, or will the markets just discount it just as they did the previous CPI report that came out this week? We're going to take a look at the report in detail and see if there are any underlying problems that we need to keep an eye on. We're also going to be covering two earnings reports that I have for you guys prepared today. Number one is going to be Evolution AB, which is a casino and software play. Very high margins, one of my favorite growth plays that I don't very often talk about on the channel, and that also is not much talked about by analysts or Wall Street. So nice little play there. We're also going to bring up the earnings from Applied Materials, which just had earnings yesterday as well, and take a look at their stock and see, is the valuation currently fair? Is it overpriced, underpriced, and how they did on earnings? And then obviously we're going to go through our major rundowns here of your technicals on the major indexes, our major tech names, and lastly take a last look in my portfolio to see how we wrapped up the week. So without further ado, guys, let's get right into today's video. SPY down 0.5% off of that bad inflation data this morning, and QQQ taking a little bit more of a tumble here, down almost 1% on the day. And in terms of yields, guys, well, whenever we get bad inflation news, yields technically do go up here, but retraced intraday. So yields still not on much of a breakout here, still remaining relatively flat on the 20-year and the 10-year as well. So we'll take a look at those when we cover our financial sector as well. So what exactly happened on the morning, guys, to preclude such a big drop off? Well, it was the producer data. So you can see strong services price increases lift US producer inflation in January. Once again, guys, services proving to be a bit more sticky on the producer side, as well as we saw on Tuesday with CPI on the consumer side as well. So let's take a look at some of the headlines here. U.S. producer prices increased more than expected in January amid strong gains in the costs of services such as hospital outpatient care and portfolio management, stoking financial market fears inflation was picking up after months of cooling. The increase reported by the Labor Department on Friday was the largest in 5 months. The report followed on the heels of an above expectations rise in consumer prices in January, CPI from Tuesday, and prompted financial markets to dial back expectations that the Federal Reserve would start cutting interest rates in June. So once again, rates getting consistently pushed back after this week's worth of negative inflation data, right? And that data on Thursday also showed prices of imported goods surging in January, but some economists cautioned against concluding that inflation was reaccelerating, noting that businesses typically raise prices at the start of the year. These price hikes probably were larger this year as businesses tried to make up for higher labor costs in the past year. So we actually spoke about this on the channel, guys, roughly about 2 weeks ago at this point, how January is a bit of an outlier period because that's when a lot of service companies such as insurance and the like tend to raise prices at the beginning of the year. So obviously we're not going to have those consistent service price increases here throughout the rest of the year. January tends to be an outlier, especially in terms of services. But as a whole, guys, I'm very pleased because goods actually came in very low. So let's take a look here at the breakdown on the Bureau of Labor and Statistics website here. So here is your total PPI for the month of January. You can see that on a month-over-month basis, it was up 0.3. Economists were surveying for 0.1. So it did come in hotter than expected here, but still, as you can see, 0.3 read in the grand scheme of things. I mean, we've had 0.3 reads all the way back to 2010, 2012, right? So it's kind of in line. There's nothing, not much of an outlier here, except for the fact that we came in hotter than the economists surveyed here at about 0.1. That's the only bad thing that was in terms of this read today. In terms of goods, you'll see that goods are still below the zero mark. So goods, in terms of from a producer standpoint, still coming down in a deflationary cycle. And that's what we pointed at on Tuesday's report as well, is that overall, guys, your goods is down. So the consumer is spending less on goods, and it has been translating as well into companies also benefiting from cost reductions in the supply chains as opposed to 2022. So they're able to pass those cost savings on to the consumer, but the consumer isn't spending as much. So overall deflation in your goods, which is exactly what you want to see. As you can see, we're back to trend prior to the increase in inflation here, 2021 and 2022. Very, very good indeed. Now, the services part of thing is where it gets a bit more tricky. You can see here that services is definitely not in line with what we've been having over the past couple of years. Services still a bit elevated, but as I've been saying, guys, January is a little bit of an increase in terms of the years. right? Every single January, you tend to get a little bit of a peak at the early part of the year. So it remains to be seen if that will be sticky over the rest of the year or if it should just come down. In my opinion, guys, it should come down, but 0.6 on a month-over-month basis is fairly rich in terms of services. So really your drawback in goods here really being counterbalanced by the increase in services, which led to your total being ever so slightly up for the month, but still nothing too bad, guys. Inflation is still coming down. It's just being sticky, but sticky around the lower bounds, which is exactly what you want to see here. We're still following the trend of overall inflation coming down. And obviously that had a big impact here on your rate probabilities change for the upcoming months here. So you can see the total probabilities now leading into the rest of the year. For the March meeting, unfortunately, on March 20th, there will be probably no change, 90% pretty much of no change. In the month of May as well, now traders largely pricing in no change, 73% of them say that there will be no interest rate change. And even in June here, we actually do have a nice little ease probability. So 79% of traders and institutions do believe that the Fed is most likely going to ease coming into June. And the market is pricing in about still 5 rate cuts for the year. So it remains to be seen. But June and July definitely do seem to be the new start of your interest rate declining cycle at this point. So just keep that in mind, guys. So as a whole, SPY and QQQ down on the day off the back of that news and really wasn't a healthy market to begin with. So very broad-based sell-off here, led down mostly by big tech, but you can see the bottom half of the market really underperforming as well on the back of that news. We had a decent recovery in the morning, but unfortunately rolled it over into the end of the day off of no news, just everybody taking profits. And don't forget here, guys, right? We are still in seasonality, and I've been talking about this for a while now. It's a bit of a lull period in the market. Now that earnings are pretty much through, we don't have any more earnings except for NVIDIA really next week. And we also don't have any Federal Reserve meetings until March 20th. So this whole period between now and March 20th is a bit of a lull period in the market. There's not much news that we can be expecting that could potentially make markets rally more. So if we are going to have a little bit of an extended period of consolidation, I do believe that for the next 4 or 5 weeks, that is going to be the likely period of consolidation. So just keep that in mind. It also plays into our seasonality, right? After the 11th, 12th trading day, you technically dip off. 12th trading day, guys, write this line right here. That was today, 12th trading day of the month. So thereafter, you may have a little bit of a decline. And that just leads into mid-February seasonality here, tapering off towards the end, and a slightly negative early March period as well. And then you can see right around the Federal Reserve meeting on the 20th, that's when markets tend to have a little bit of a rebound here coming into the spring and summer months. So just keep that in mind. Still expecting some consolidation, and this would be the best period for the markets to do it in. So just keep a very close watch here on that. I still do think that right now is the best time to be writing covered calls and to take some profits, really start tapering back on your bets here for further continuation to the upside. So with all that being said, before we do more technicals, let's get into some earnings. And the first one that I have for you guys is going to be Evolution AB. So this is an online casino company here. What they do is very, very simple, guys. They have they're the industry leader pretty much in your online casino games. So what I wanted to show you is these are the online casino games. You might have seen them before, whereby it's pretty much a webcam and there's a dealer in front of you, and anybody from around the world can play these live games, right? So they have live poker, blackjack, obviously have a lot of slot machines and whatnot, but this has been a very big experience ever since 2021, the pandemic. A lot of people have pivoted their online betting experiences, or they've pivoted to online betting experiences in favor of going to actual casinos, especially for if you don't live close to any casinos. This has been a very big segment here up on the rise. So they're one of the leading companies in that market. You can see here all the partners that they do have. Let me just present you their partners real quick. They're partnered with pretty much the biggest and the best in the world at this point. So you'll probably recognize a lot of these if you have any experience in dealing with casino brands or whatsoever, but you'll see they're partnered with pretty much everybody. They provide this service to almost all of the big casino, chains, right? So you have a number of them. DraftKings, you can see down here, they're partnered with MGM, they're partnered with Wynn Resorts as well, Leo Vegas, PokerStars, Penn Gaming, right? Tons and tons of large companies, and even mine from Quebec, even my casino issuer here and gambling governmental agency is partnered with them. to provide this online gaming experience here, or this online betting experience. Very, very solid stock. If you can see here, guys, on Guru Focus, which is a very, very solid website for fundamental analysis, they have a Guru Focus score of 99 on 100. And that was not only for 2024, but even last year as well, to about 99. 2022 was a bit lighter at 88, but you can see here a very solid fundamental company. And I'll show you a few of the metrics why here. So they have extremely, extremely high profitability. And this is why I like this company pretty much. We have extremely high profitability. You can see here their 2023 earnings that they just reported about a couple weeks back, ending net margins, guys. 59% net margins. You can see this nice little increase in net margins, but ever since 2021, they've always been above 50%. Very good margins, better than MasterCard, better than Visa. This is one of the most high margins business that I've ever seen in any stocks as a whole. So very high profitability. Their fee structure, so their revenue structure, it's a fixed fee basis plus commission structure, which means that they charge these casinos a fixed fee for using these services. Now, what do? Is they have different locations where they employ people, and they'll set up these rooms basically that are tailored to a casino's experience. So let's say you're MGM Grand and you want to provide online betting services and online poker tables. Well, they'll hire employees for you. They'll have this center potentially in either Eastern Europe or Latin America, and they'll even give employees custom merchandise with MGM Grand logos and stuff like that. So they're basically the middleman. And because of that, they earn a fixed fee for providing that service, but they also generate commissions whenever you play, whenever players are gambling and whatnot, whenever those casinos, let's say the MGM Grand, whenever they make money on consumers' bets, well, they have to give a portion of that commission to Evolution AB as well. So it's a dual revenue stream. Very, very good business. 13% EPS growth over the next couple of years, 15% revenue growth. Very good, guys, over my rules of 10 and 10. So this is outperforming your regular S&P 500 growth rates. Their 2024 PEG is only about a 1.6. Very decent, guys, for the amount of growth that this company has. Company is pretty fairly priced, if I do say so myself. That Guru Focus website as a whole does have a price target on the stock for the next couple of years of about $180. And I would tend to agree after running a bit of multiples analysis on it. 160 to 170, pretty much back to the all-time highs, should be a given for this company. It's currently on a nice little extended dip, but the bulls are really trying to recapture this monthly uptrend right now. And I do believe that will be set in motion. No red flags for the company whatsoever. They also have just announced at their most recent quarter here, finally a share buyback program up to 9.5% of outstanding float of the shares over 2024. So that's very, very good, guys. We're talking about, roughly about $2 billion worth of shares. That'll be about 9.5% of the company. Extremely good buybacks. They're using all of that free cash flow, all of that extremely high margin business to buy back some of these shares. You can see here consistent EPS growth over the next couple of years, consistent revenue growth, exactly what we want to see. And some of the financials here, oops, that's the wrong one. Some of the financials here is going to be extremely good. Look at this low debt here, guys. Extremely good free cash flow on a year-over-year basis. This company brings in almost $2 billion in revenue for 2023, and over half of that is free cash flow. They're sitting on about 1.1 billion of cash and cash equivalents. No debt at all. The reason they don't have any debt, guys, is the way that this company expands is they do acquire competition, but they do that with shares. So the only time you'll get diluted is if they acquire other participants in that market, but they are the industry leader, guys. They control the business. It's very hard for new participants to enter and compete with them. They're pretty much one and alone in that business as a whole in terms of the size of the company and the amount of partnerships that they have. So very good. So they don't use debt to acquire new businesses or whatnot. They use equity, but they're largely through most of their equity purchases over the last couple of years. They've literally purchased up all of the competition, and now they're sitting all on top, all alone, just by themselves. Now, a few of the cons that they may have: regulatory risk. Obviously, it's a gambling business, right? So there is always regulatory risk. But since they're the leader and since they've brokered a number of deals with governments across the world to be able to run their business as a middleman, The regulatory risk is literally small. They've already gotten through most of those hurdles. And the second con is they have limited USA penetration. Now, this isn't something necessarily with the company itself. It's just the USA, right? In the USA, you're only able to online gamble in only about a handful of states at this time. Now, the legislation should be improving over the foreseeable future, over the next couple of years, to allow more and more states to have online gambling facilities. But it's pretty much the same, right? As DraftKings or Penn Gaming in the US, it's very tough for them because of the US market's restrictions. So they do have somewhat limited penetration in the US market, but all companies do, just because most states don't allow online gambling yet. But that should change. That's also could be considered as a pro for potential upside in the future for the company. Now let's take a look, guys, at some of the more specific details of this company. I'll show you why I like this company. So let's take it off with a bit of guidance from the CEO. So we see encouraging development in all the regions going into 2024. North America showed strong momentum in Q4, coming back to sequential growth. There is still untapped potential in Europe, and it remains a region with good potential for evolution. Asia and Latin America are the fastest growing regions year on year at the moment. Brazil's announcement of an upcoming regulation of online casinos came at the end of the period and is a sign of the rapid development of the market in this region. They're more forthcoming and accommodating with online casinos, so Brazil is going to be a big market for them. We will continue to invest in the Latin American region in the years to come. We've increased the pace of our studio expansions in the fourth quarter and expect to continue into 2024. We launched a new studio in Bulgaria and have initiated the project to build a second studio in Colombia. Investments in 2023 amounted to about 94 million euros, which was below their capex guidance of 120 million. For 2024, they'll repeat the same capex guidance of about $120 million. Not a lot of capital expenditures, guys, when you consider they're making about $2 billion in revenue, only capex of about 5%. That's extremely, extremely good. And it's cheap for them to do, guys, because they set up all these studios, mostly in Eastern European countries or Latin American countries. Well, the labor is cheap. That's not to say anything about the people. It's just the standard and the quality of life in those countries and whatnot just warrants a little bit of a lower minimum wage. And that's why the company is opening all these studios in those countries as a whole. If MGM Grand or a lot of these other casinos were to open some of these studios in either Canada or the US, the costs would be absolutely astronomical in relation to where the business is currently hosting their studios. So very good decision by them to do that. Now let's go through a bit of their numbers, guys, and I'll show you why I like this company so much if it wasn't already clear from their profitability. Now let's just see the geographic breakdown. You'll see that Europe is still their largest market, followed closely by Asia. North America, severely underexposed, right? But still fairly decent. Latin America, about 33%, and then the other. So very good exposure in Europe and Asia, extremely good penetration in those two markets. Financial development, look at this beautiful revenue curve, guys. And the earnings, as they grow revenue, they grow earnings at roughly the same pace while costs remain roughly the same. So that is very, very good. That allows them to continuously increase these margins on the top line. Extremely good, guys. A company with gross margins of 71% and bottom line margins of high 50s is absolutely insane. It's very, very rare to find a company like this. Now let's take a look at some of their expenses, right? So they have total operating revenues of about 1.45 billion here in 2022. That was up netly into 2023, up to about 1.8 billion dollars. Very, very, very good indeed. Their personnel expenses, not so high. Depreciation and amortization, okay. Other operating expenses, not so bad. Their total expenses as a percentage of their revenue is really not that bad at all, guys, considering what this company does. And here's your operating profit. Once again, 1142 divided by 1798. You can see those beautiful net margins of 63%. Absolutely ridiculous, right? Now, look at their capex here, guys. So you can see that as a percentage of revenue, this line right here, their capital expenditures are going down as their revenue continuously starts to increase as well from the previous chart. So that's always good. It shows the company has positive operating leverage when they can grow revenue a lot faster than their expenses are growing. And even they don't have to outlay that much more capital to grow the business. So that's very good. Operating cash flow is absolutely huge, continuously increasing year over year. And now with their most recent buybacks, they're going to be using all that operating cash flow to put that money back into your pocket as a shareholder. So I absolutely love this company here. There's really nothing bad to say about this company. I personally have invested about 30 shares down here at the about 111 level. That's what this arrow is representing. And I am going to hold these shares. If we do get a little bit of a dip here into the end of February and early March as the whole market pulls back, I will definitely be adding if we revisit those lower levels here. 110, 111 seems to be a very nice price for a very beautiful company. It's trading at a relatively cheap valuation, and the upside, guys, we should have a fair amount of upside, and the total addressable market of the company, guys, is going up as well. You can see here the online gambling worldwide segment here projected to grow to about $138 billion in revenue by 2028. So beautiful expansion. Compound annual growth rate of that entire market is about 6%, and they are the industry leader. So I will go with them if I do, if I do have one pick in terms of the hospitality and gambling trade to take, I'm definitely going to play this one as opposed to any others. So hopefully that was helpful. Hopefully it provides a little bit of insight. And if you do like this company, be sure to do a little bit more research on your own. And I'm sure that you're going to like what you potentially see. Now, the second company we're going to be looking over is Applied Materials. So semiconductor play. This company most recently had earnings pretty much on Thursday, right? Beat on EPS by about 12%, beat on revenue by about 3.4%. And the stock was pretty much up 6.35% after their earnings, now up all the way to the all-time highs, but it is getting a little bit rich for me, guys. And we'll go through their numbers and we'll see exactly why. Now, they're the industry leader with ASML. Now, so these are companies, so Applied Materials does almost the same thing as ASML. They sell different machines, but the machines are purposed for the exact same thing. They help semiconductor manufacturers manufacture the actual chip. So they are the picks and shovel business. They're selling machinery that helps in the semiconductor manufacturing process. And as this line just says, they're the industry leader with ASML. Nobody else really comes close. Now, the company does also have positive operating leverage, meaning it's growing its revenues faster than it's growing its expenses. Very, very good. Revenue expansion at about 6% for the next couple of years, EPS expansion at about 8% for the next couple of years, which is fairly good, a little bit low as opposed to some other semiconductor plays, but still good. So EPS expansion, revenue expansion over the next couple of years. They have a 2024 PEG ratio of 3, and this is where a few of my valuation metrics come in, guys. The company is valued very rich right now. 3 is a bit too high for their current growth, what they have right now. So I'd like to see that come a little bit down, which is why I'm not a buyer of Applied Materials up here. If I had some shares, I wouldn't mind holding them, but initiating a position at these higher levels is just not for me. Now, they do have low debt and very high free cash flow, and we're going to take a look at this right here when I show you the slides. So in terms of gross profit margins, excuse me, you can't see me, but they just put in 26 net margins across the year, which is very, very good for this company, right? Usually that's pretty standard with semiconductor plays, about 25, 26%. That's kind of in line with companies like TSMC and whatnot. 2023 ending, you can see only about $6 billion worth of debt. Very high free cash flow for the year, $7.59 billion, and already sitting on about $6.1 billion of cash and cash equivalents. So the balance sheet is very solid. They do have buybacks in place for 2024, 7% of the outstanding float, which is a very decent number as a whole, guys. But as I said, this alone is not going to make me buy the stock. The valuation is still high, despite the fact that they can buy back a lot of shares. And the last positive point that I like about the company is they have low stock-based compensation as a percentage of their revenue. So when we took a look at the other companies the other day, Trade Desk namely, and a few others that I can name off the top of my head, like Cloudflare, Coinbase, and whatnot, they were running share compensation packages for management and executives as about 20 to 25% of revenue. This is an adequate number, only 1.6%, so that's a good thing for the company as a whole. Now let's take a look at some of the headlines here. So Applied Materials delivered upbeat results and guidance Thursday afternoon as its stock surged in the extended session. Our leadership positions at key semiconductor inflections support continued outperformance as customers ramp next-generation chip technologies critical to AI and the Internet of Things over the next several years, said your CEO. The company expects $6.1 billion to $6.9 billion in revenue for the ongoing quarter. Midpoint is going to be 6.5, beating out the 6.34 billion in the consensus. So they raised guidance here for the first quarter ongoing right here. So that's going to be very good. Nice little beat and raise by the company, which is what I was talking about yesterday. when we went over their post-earnings results. Now, in terms of the numbers, guys, the numbers are very, very good. Really nothing to pick apart about this company. The only bad thing, guys, is the share price, but the company is extremely, extremely solid. So here, gross margin expansion in the most recent quarter, flat revenue, however, that will be increasing over the next year, but on a quarter-over-quarter basis here, it will be flat in relation to Q1 of 2023. Operating expenses, you can see operating expenses not so much higher, right? Only a year-over-year increase of about 6%. That's not that bad, but they should be growing revenue at a higher pace than this. So not that bad at all. Operating income got up as well. Operating margin never changed either, and continuously expanding EPS. So everything you want to see in a company, guys, as a whole. Now, in terms of cash flows and shareholder distributions, you can see that they do generate a ton of free cash flow on a quarter-over-quarter basis. And this quarter was pretty much the same, $2.1 billion in free cash flow. Very, very good. Committed to distribute 80 to 100% of free cash flow to shareholders over time. So that's going to be dividends and share buybacks. So they're using their cash efficiently to reward you, the shareholder, right? So very, very good for them as a whole. Nothing bad to say. Could pick apart their balance sheet, but no real need, guys. They don't have any miscellaneous expenses that you should be worried about or anything like that. And here you go. Strong history of shareholder distribution. So over the past fiscal years, they've grew dividend per share at 12% compound annual growth rate, very good, reduced net shares outstanding by over 30%, and they've distributed 91% of their free cash flow. Very decent indeed. So in March 2023, they approved another dividend increase of 23% and $10 billion of supplemental share repurchases through 2024. And here you have your dividend increases, beautiful since pretty much 2005, and your shares outstanding continuously decrease as the company uses this free cash flow that they generate to continuously buy back shares and kind of nudge the share price higher. So that was very good by Applied Materials. Nothing bad to say about them. And if you want to take a last look here, guys, just to prove to you guys that they're not compensating executives too much with share-based compensation, take a look at this share-based compensation for January 2023. This is for a quarter, so we'll just take the quarter. They don't have the full year right here because they run a fiscal year a bit differently. So this is actually their Q1 statement, not the Q4. So share-based compensation, $170 million. That's not that bad when you consider that the company is generating on a quarterly basis pretty much, like $6.7 billion in a quarter. So if we just do 170 divided by your 6707, that's where you find the roughly, 2%, 2.5% of net revenue. It's very, very low, guys. Not very high at all. So very, very decent as a whole. Now, if we take a look at the valuation, guys, that's the only problem. As I've said, only problem with Applied Materials is the valuation is a bit too high. It's the same thing I was saying with ASML. So take a look at their PEG ratio, right? PEG ratio is about 3. If you want to put this on a common denominator with ASML's PEG ratio, yes, they're growing EPS faster than AMAT. They have a higher PE ratio. So we have to put these on a common denominator to make sense of the difference between AMAT and ASML. And you do that with the PEG ratio. So the PEG ratio here for ASML is 2.82, still too high. I like companies between 1 and 2. The best company, in my opinion, for semiconductors remaining at the best value in terms of for productions of semiconductors, not talking about AMD or NVIDIA here, but in terms of production, your picks and shovel companies, basically, it is TSM, guys. The revenue, EPS growth, 12 and 14%. PE is pretty low for 2024, which gives them a PEG ratio of only 1.47. So on a relative basis, TSM, despite the fact that they trade at a $500 billion market cap, right? TSM is almost 2 times cheaper when we put everything on a common denominator in terms of the PEG ratio. PEG ratio for TSM through 2024, only about 1.5. And as you remember, ASML, 2.8 roughly, 2.8 on ASML. And Applied Material was about a 3. Applied Materials right here was about a 3, right? So that's why TSM is my favorite play in semiconductors in terms of a picks and shovel company for the industry in that respect. A lot of semiconductors plays have run a ton so far this year, but TSM provides very decent value or some very decent remaining value in the industry despite its high growth. So hopefully that was helpful for all you guys. Now let's dive into our technical analysis on our major indexes and see how we stand. So SPY over here, what were we looking out for here, guys? We're looking out for the continuation of the daily uptrend for the daily higher high, but there is a problem, and the problem lies in the lower time frames. So we're looking, how long can the bulls maintain this hourly uptrend? They maintained it for a fair decent part, but lost it into the end of the day potentially meaning a 4-hour rollover. You can see the 4-hour curling below our moving averages right now. So S&P 500 potentially setting the lower high, almost a double top. Will we be heading into lower low after these negative CPI reports and PPI reports over the course of the week? Will we be heading into potentially lower and lower for end of February and March? And is this potentially setting a temporary top for the markets before setting a daily downtrend into weekly consolidation? If you ask me, guys, I'm pretty much leaning 70-30 at this point. 70% of me does believe that this is potentially the time for the markets to roll over and consolidate. If that does happen, target these lower levels down below here. We're talking on a weekly consolidation basis. 480 down pretty much to about 470 is your big area of support. It coincides with your previous all-time highs. Now, bulls are still in full control of these markets, don't get me wrong, but you have to be a little bit cautious when you see the lower time frames rolling over here just short of your all-time high. So the best case scenario for the bulls is maintaining a tightening range at the top, something like they kind of did over here. But if we do tend to roll over and could go past these lows, 491.21, right? It'll be a daily downtrend, first daily downtrend since the month of October. And I do believe, guys, if over the course of the next week or so, we get the daily downtrend, that will be for about a couple weeks of extended weekly pullback after such a beautiful rally. Cool off these weekly RSIs would be a good timing and position for the market. Now moving on to QQQ. QQQ failing a bit lower than SPY. You see SPY got a lot higher on this bounce. That's largely due to your push from financials and healthcare. But QQQ technology, guys, over the past couple of days have not been having the best time. So it still is a daily uptrend. Daily higher low is set. Then now we may just be looking to roll this over. Hourly trend also rolled over into the end of the day. So next line in the sand, 425.75 for the bulls to defend. If we lose this over the next couple of trading days, it will be the first official daily downtrend since the month of October as well. And at that point, guys, you can be expecting a little bit more weekly consolidation. Weekly consolidation first target for me will be about 413 with this 12 EMA. The real area that they have to protect, guys, is this weekly higher low. 396 cannot fall if you want to maintain a healthy weekly uptrend at this point. So just keep that in mind, guys. 413, and then we come down into this green box, which is going to be your previous all-time highs. That's pretty much your 405. 400 level is going to be the second stop. And if we do come down all the way into there, it would be an additional pullback. We're looking at about another 6-7% for the QQQs. That means that big tech would largely be off their all-time highs or recent highs, depending on the name, between about 8, 10, 12%. And that, I do believe, will be the last couple of deals for the remainder of the year. So this is going to be a very big opportunity to go shopping, in my opinion, from now until the month of March if we do get this market rollover. So I'm excited. I'm not nervous about the market rollover. It's done what it had to do. It's been a beautiful rally over the past 4 months pretty much. Now looking for a bit of consolidation. It's going to be time to go shopping and add to those long-term positions. So now moving on to financials. Financials looking healthy, however, right? So financials did get the daily uptrend break to the upside after this beautiful consolidation range. So we're now just looking for a daily higher low, anything above 38.41. Going to be looking daily higher low for further trend continuation. Financials do have a beautiful previous resistance, which is now support at about 39.30. So not too far off the current share price. And then you have your 12 EMA down here, 39.14, but must protect this, right? What we're going to be looking for, if we do get a sell-off over the course of the next week, if it's going to be a broader market sell-off, then QQQ, XLF, and XLV will all pull back at the exact same time. If you get QQQ pulling back, but XLF maintaining these daily uptrends and XLV Healthcare maintaining these daily uptrends, well, your decline in SPY may be very, very muted, and QQQ may be the bigger outlier here. So just keep an eye on that rotation. For now, QQQ not looking too healthy, but financials, nothing bad to say. Bulls in still in full-term control right now, right? Second beautiful weekly leg up. But even if financial bulls roll this over in the next couple of weeks, guys, 38, 37.50 is your next big area of support, and it's going to provide a nice little opportunity to set a weekly higher low for further trend continuation into 2024. Financials looking very good. Moving on to healthcare. Healthcare as well, pulling really high on the day, but then retracing a lot of it into your end of the day. But your short-term bulls still look healthy. This is a picture-perfect daily uptrend at this point. Any pullback, just looking for a daily higher low, 142.19, line in the sand. daily higher low for further trend continuation. But if the bears pull back too much of this move, may be also setting up for a rollover on the daily. If that does happen, we do head into February, March consolidation, guys. Just keep an eye on your previous area of all-time high for the weekly lower high. Previous all-time high is sitting roughly at about this whole 142 zone. So 142 all the way to about 140-ish, right? That $2 range right here is going to be what we're looking out for a very, very nice, healthy area of pullback for your bulls. As of now, no red flags whatsoever. Financials and healthcare are your two sectors responsible for keeping the SPY relatively healthy. Now, IWM Russell still failing to break and hold above this level. What were you looking for yesterday, guys? I was saying I need to see a hard weekly close above this $201, $202 level, really get a clean break and close above our previous 1.5 years of resistance. That hasn't happened yet. Once again, unfortunately, because of the data today, pulling back on the day. But on the short-term, bulls still in short-term control here, still on the daily uptrend, looking for a pullback. Any dip is going to be for a higher low above 193.30. If we can set a daily higher low into this range and break out to the upside next week, if the market rally does continue, then hopefully next week we'll be able to close a candle above here, setting in motion the weekly leg number 2. And at that point, guys, if we do then taper off, let's say we get one more week of bullish continuation, thereafter, maybe last week of February and a couple weeks in March, a little bit of a pullback, that is when you want to see the breakout, retest of this range. And when we're retesting this range, that's where I'm going shopping. But as of now, bulls still in short-term control, but keep a very, very close eye on this chart, because if the rest of the markets start dropping off, I do believe we'll just continue to consolidate sideways in this tightening range, potentially re-pulling back into the lower 190 area. And now the Dow Jones. Consolidation on the day, but Dow Jones really looking very healthy, guys. 12 EMA is going to be the line in the sand, but Dow Jones just the same. You can see we're kind of failing this double top attempt at the all-time highs, right? So if Dow Jones over the next couple of weeks rolls over and flushes 38,100, that is going to be the cue. First daily downtrend since the month of October, pretty much. And we will be looking for a bit of weekly consolidation at that point. Dow Jones, tons of space, anything above 37,136. Just going to be looking for a weekly higher low for further trend continuation of the upside. That represents potential downside of about 2-3% on the Dow Jones. So we'll see how well those value names do hold up. And even if we do cut the weekly higher low right here with a very big area of support, which is your previous all-time high, 36,800 down to about 36,500 is going to be the area to watch. That would just provide some temporary relief for the bulls here. Nice little monthly higher low area to be set for further trend continuation. So could just be the time, guys, on all of these charts to have a little bit of weekly consolidation, which could translate into a negative rest of the month of February and maybe even early March monthly consolidation as well. As I've said, it's been 4 months of beautiful rally, SPY, QQQ, XLF Financials, XLV as well, even the Russell coming up for the past 4 months, and even the Dow Jones as well. So things a little bit extended right now. We'll see if that seasonality plays out indeed. Now, guys, let's move on to lastly, we're just going to cover yields very, very quickly. So let's go over the 20-year. So you can see here that we are currently in a new weekly uptrend, but so far, so good. We're just looking for a monthly higher low, guys, and that's because the bears took back so much of this move. If you take an eye on how much they took back, right, took back almost 75% of the move. So in that case, guys, you are expecting a lower high for potential lower low break of structure to the downside, finally setting a monthly downtrend ever since this started upticking since pretty much the 2020 period. So finally, a little bit of a peaking all out period in yields. I don't believe that yields will continue to skyrocket, guys. The interest rate hike cycle is largely over. And as we get closer and closer to that first rate cut, well, inevitably, these yields will have to start coming down. So now is pretty much the last time where these yields can rally a little bit off of negative inflation data and repricing the date of the rate cuts. But that's pretty much it, guys. So far, so good. Yields are going to be trending long-term down, in my opinion. And the 10-year paints the same picture. Yes, it's a weekly uptrend. Yes, it's a daily uptrend as well, but we're just looking for the monthly higher low. And these are somewhat volatile, but don't move obviously as fast as stocks. So it does take a little while for these to roll over. So we'll see how that plays out, but the yields may stay a little bit elevated if we do end into consolidation on your broader markets here, February, end of February and March. Yields may continue rising ever so slightly, guys, but we're definitely not expecting this. Nothing like that at all. Now let's move into our tech names and then we'll do my portfolio. So big tech. Apple still offering the possibility of taking some trades in the lower $180 range. Now, Apple starting to be in jeopardy of losing this, right? If we lose this low right here, 180 pretty much, daily downtrend is in motion. And at that point, weekly downtrend will be in motion as well. So is that a bad thing if the bears take control of the daily and the weekly? Not really. We still have control of the most important time frame of them all, the monthly time frame, guys. And at that point, anything above 165 is just going to be looking for a monthly higher low. As you can see, Apple's been consolidating largely sideways and slightly down for the past 3 months at this point. No surprise there. Apple does tend to do this on a regular basis. When they achieve higher highs at that point, they tend to consolidate and really build into their current valuation. Apple's revenue is not supposed to be that great for this upcoming year, 2024. So we'll see what happens with that, but still a very solid company. I really like this, guys. If we get a breakdown below, especially if we get some oversold conditions in the next couple of weeks on Apple, Apple is such an easy trade. Whenever we hit daily oversold conditions, it's usually a very easy buy in the zones where we hit oversold conditions, guys. It usually tends to have a little bit of a bounce as soon as we do tap into those daily oversold conditions. So I will be looking for daily oversold conditions if we pull back into this area. Bulls have to put a stop to this. If they do put a stop to this, very simple, we're going to look for the size of the bounce in relation to our most recent lower high of 191, pretty much the size of the bounce. If they bounce high enough, set up a nice chance for a daily trend change. But if we don't bounce high enough, may just be rolling over to the lower low. You can see the bulls had a decent bounce here, but it still wasn't enough. And look, take a look at the size of this bounce here, guys, right? It was over the 618 and bulls still not able to get it done. So the bounce was good, but not perfect, right? The perfect bounce would be over about the 80% level, get me clear and past from this resistance zone 190 to 187, this yellow box right here, clear above, retest it as support and then go. But now we're kind of below that support area, below the moving averages, and tapping into our lower support zone range, which is going to be a 180 all the way down to that 165. 175, 170, guys, is going to be a very juicy area for Apple. Now moving on to AMD. AMD still consolidating sideways here, 1.63% to the upside. So you're looking for the daily uptrend breakout of this tightening range, but unfortunately just did not happen, as most semiconductors did not have that good of a day today. So AMD failing the breakout once again. At this point, guys, remains crucial if the markets do sell off. Keep an eye. Previous all-time highs, 164 to 158, very big area of previous resistance, which should now be acting as support. It has been acting as support for the past 3-4 weeks at this point, but if ever we lose this, guys, well, it'll be daily downtrend confirmed at that point, and we will be heading into further weekly consolidation, but AMD bulls a lot of space. Anything above 134, just going to be for a weekly higher low for further trend continuation. AMD, for me to make any future plays on AMD, has to be below at least 150. I'd really prefer to get it in the 140, 130. So we'll see if the next couple of weeks we have a tremendous sell-off in semiconductors, a little bit of a repricing to the downside after such lofty gains. Well, that might be an opportunity to go shopping for some AMD, even potentially some NVIDIA and some other semiconductor plays. I'm looking forward to it. But as of now, bulls still looking good, still maintaining this tightening range, which is healthy, but this is going to be beholden to the overall market. And obviously NVIDIA earnings next Wednesday will have a large impact on the stock as well. So I am expecting the price action to be fairly muted until those NVIDIA earnings. And NVIDIA earnings, if they're a disappointment, expect AMD to also follow suit and potentially challenge to break this most recent support area and maybe just be due for further extended weekly pullback. But as of now, bulls still healthy, still holding this weekly bull flag for potential further price expansion. Amazon also looking somewhat decent, guys. It is a little bit choppy at the top here ever since they're earning. So this is pretty much sideways consolidation. You can see that on the RSI, sideways consolidation, but right? Look at this MACD. MACD finally starting to cross now, which may lead Amazon's momentum to taper off to the downside. If we lose 165.92, let's call it 166 into next week, that would be a daily downtrend. If we get the daily downtrend, very simple, just further weekly consolidation for Amazon, not looking bad at all. Weekly higher low, anything pretty much above 145, just looking for a weekly higher low. So even if we don't break to these new highs and the market starts retracing, well, we have a little bit of an earnings gap to be filled down here all the way to about 160. So even if we pull back, guys, to about 160, that will be right where the 12 EMA on the weekly is. And you can see the weekly 12 EMA has been playing very beautiful defense on Amazon. If I can get Amazon plays under 160, I will be very happy over the next couple of weeks, guys. As I've said, watch for about 8, 10, 12% discounts on your major tech names from their most recent highs. And 157, 160-ish, that would be about 8 to 10%. So that's the area that I'm personally looking at. Bulls looking decent. And obviously, if Amazon just beautifully recovers next week, well, we are just looking for a potential daily uptrend breakout and weekly breakout of your previous area of all-time highs, the 175, and then peaking around the 187. But unless overall market conditions are extremely bullish, I don't think the company is going to do it on its own. Now moving on to Google. Classic Google coffee sip. So moving on to Google, guys. Google as well, kind of like Apple, right? In jeopardy of maybe setting up for the daily downtrend. That would be a loss of the 138.14 low. Keep an eye on that. But Google is coming in very big area of previous resistance, big area of support now. 141 to about 138 is the line in the sand level for me. The weekly higher low is a bit lower than that, about 137.40. So still in a beautiful weekly uptrend, but quickly coming back down from your previous highs that were set earlier on in January. So Google is still a very nice purchase for me in these lower levels, guys. I really love it. Anything under 140 is a no-brainer buy for me, in my opinion. The forward PE ratio for Google for next year is about a 20-21, so it's extremely cheap. Pretty much the cheapest big tech name as a whole. Best case scenario for the bulls, guys, is going to be setting up for a bit of a tightening range. Now, they had a beautiful bounce here to try and recapture this lost daily uptrend after earnings. Now, the bears have taken back a little bit too much of this bounce for my liking. So the best case scenario right now for the bulls is maintaining a tightening range through consolidation, maintaining above your 141, 148. But if ever we get some downside continuation, keep an eye. 141, 138 should hold. If it doesn't, we're looking a bit lower. 137 for your weekly higher low. And if we lose the weekly higher low and lose the weekly trend, well, Google will go into a little bit of monthly consolidation, maybe end of February, early March as well, maybe revisiting the mid 130s. But at that point, it would be a no-brainer buy for me, guys. Very healthy monthly uptrend, just looking for a bit more consolidation with the rest of the market. So we'll see how it plays out. But Google looking extremely attractive. One of my favorite stocks to trade right now. Moving on to Meta. Meta, same thing, right? Consolidating at the high, no real pattern whatsoever. Meta still looking for a little bit of the daily trend breakout, but today just consolidating a little bit, 2.21% to the downside. So keep an eye on these lows right here, guys. 454 crucial level. Lose that, you lose the daily uptrend, and we may just be in for a little bit more weekly consolidation, but Meta has room to give. Weekly expansion is beautiful. Any weekly consolidation, anything above 340 is just going to be for a weekly higher low. And Meta can pull back, even to pull back 50% of this move, right? Let's call it about 412-ish. They can pull back 15% and still only pull back 50% of this entire move up, which would still keep the bulls healthy for some trend expansion. Upside targets, obviously $500 psychological level is going to be the key. And Meta, relatively cheap as well. 1.62 peg on a forward 2024 basis. Very cheap. That's what we did when we saw the trade desk earnings yesterday. We compared it to Meta, and Meta is the better buy if you're looking for a pure form advertising play. Very good margins, very good cost control, EPS expansion, relatively decent free cash flow yield as well, low peg ratio, everything you want to see in the company. Just a little bit rich in terms of the RSI, and even the daily RSI still quite elevated even after consolidating sideways for 2 weeks after earnings. So we'll see what happens with Meta. So far, so good. If Meta comes back 420-ish, I'm going to be playing Meta. Moving on to Microsoft. Microsoft almost losing the lows here today. As a matter of fact, did they cut them? The low here, 403.39, and the low of the day, 403.44. They cut it by 5 cents. So Microsoft, if we have a red day on Microsoft Monday, first daily downtrend on Microsoft since September. Right? So that would be notable to us if ever that does happen. So keep an eye on this break. If we do get a loss of the daily uptrend into daily downtrend, then weekly consolidation is inevitable at that point. With the way the weekly closed, I would not be surprised if Microsoft continues consolidation into next week as well. Just looking for a weekly higher low, anything pretty much above 365. Weekly higher low for further trend continuation. Microsoft looking very good. And if we consolidate for a couple more weeks here, February, March as well, I will be looking, guys, as close as possible as I can get to 375. I'll be looking to make some plays on Microsoft. Just looking for a monthly higher low, anything above 310. Just looking for a monthly higher low as well. So this whole market, guys, if we get the daily downtrends in motion, you're into weekly consolidation. And since we haven't consolidated on the weekly in quite some time, even monthly consolidation on a few names too. So has to be notable to us, maybe due for a little bit, 4 or 5, even 6 weeks of consolidation, but it's all worth it. We will be looking to buy a lot of these attractive big tech stocks lower than they previously are, potentially back down into some early January levels. And with their with their earnings now being passed, you know that you're buying solid companies that have expanded guidance for 2024. So that is the certainty that we have now that we did not have back here in January. So looking good. Now moving on to Netflix. So Netflix still holding above our previous area of resistance. So Netflix doing a great job, better than most, right? So they set the daily downtrend here, now engulfed the entire move and closed above our area of resistance, which we were targeting 575 to the upside. What I want to see from Netflix, if they can hold this, right, if market conditions permit, if the rest of the market doesn't fall off a cliff, if they can hold this level into the next couple of weeks, break out a little bit higher, all the way potentially past about 600, then retest this area as support, that is going to be a beautiful breakout retest trade that I'm looking to take. As of now, limited price action above, but bulls are in control. Any move lower, just going to be looking for a higher low, anything pretty much above 550. Higher low for further trend continuation, looking very good. Weekly uptrend, full control by your bulls as well at this point, and even the monthly trend expansion looking excessively good for Netflix right now. So nothing wrong with this stock whatsoever, just little bit of bearish divergence right now. So you can see the highs on the RSI versus the highs on the market, pretty much counterbalancing each other, right? So a little bit of bearish divergence there. So it may just be due for a little bit of a pullback here. So we'll see what happens with Netflix, if it can really mount and stay above this 575. But if the rest of the market pulls back, Netflix unfortunately will be pulled back with it as well, I do think. Now moving on to NVIDIA. So NVIDIA pulling back a little bit as well, right? We haven't had back-to-back red days like this on NVIDIA for quite some time. So is the market potentially topping out before earnings? It's going to be very limited, guys. Very tough to determine price action when you have earnings on Wednesday. So we'll see what happens with the company. All I can say for now is the company is in a beautiful daily uptrend. If you fail this low right here, for 697 to the downside, you are potentially setting up for daily downtrend, and at that point you will be setting into weekly consolidation mode. So we'll see what happens. Weekly consolidation would be very healthy for NVIDIA right now. We'll see what happens on their earnings. Bulls still in control, but I would be not nervous coming into earnings, but if I would not be starting a position personally on this company leading into earnings, especially not with the broader market and how the broader market could be potentially due for a little bit of pullback. I do think that NVIDIA is going to report good earnings, but if it isn't an astronomical, exceptional beat like they have been giving in the past couple of quarters with very high increased guidance, because they already have increased guidance a couple times now, right? Well, the earnings may just be good, but the market may just sell off, and then everybody's going to say, well, the earnings move was already priced in prior to their earnings. So just be very wary of a situation like that. Would not be surprised if it happens on NVIDIA. Now moving on to Tesla. Tesla looking fairly good, still daily uptrend in motion. Any pullback at this point, looking for a daily higher low, anything above 182.36, daily higher low for further trend continuation at this point. Looking good. So need to see the bulls continue this daily trend motion here, preferably as high as possible to 220, 230. Why? Because we're looking to take back a lot of this weekly, most recent down move on the weekly. Need to pull back at least 50% of that, and that's 220. 60% would be better, about 231. So that's what I want to see here, guys. But just be careful if the rest of the market pulls back. That's why I give these expectations. Don't expect Tesla to do it all on its own. At that point, Tesla will probably undoubtedly roll over. So far, so good though. Daily bulls in control. The only problem is the weekly bulls are still in control. So you're just weekly bears are in control, looking for a lower high for lower low. Big chop zone up here, right? 213, 215, big area of resistance that we're currently coming into. Your moving averages are right there at about 220 as well. So that whole area, 215, 220, going to be tough for Tesla to really mount and close above those levels, especially if the market kind of unwinds here for a little bit. That being said, if we ever do set the weekly lower high and lower low, we're still looking 180 down to 170 zone. Should be a good bottoming out area for Tesla. Bottom end of your downtrending channel right here, and horizontal support. As of now, bulls still looking good. Just keep an eye, guys. Can they hold the pattern? As long as the bulls are continuously in control of the daily time frame, it's good, right? Just need to get about 215, 220 before this daily trend tops out and can roll over, and we can still be looking for the bulls to set a higher low for higher high continuation. Now moving on to Palantir. Palantir finally pulling back a little bit, 3.82% to the downside. So failing at the previous 52-week high twice now, and now beginning to roll over. So keep a very close eye. 23.27 if your lows. If we roll over that, it would be daily downtrend starting. And at that point, you're just going to be looking for weekly consolidation after earnings. But Palantir is so much space here, guys, right? We're going to be looking for your previous 52-week high here, right about $21.50 all the way down to $21 is going to be the next big area of support. And if we do consolidate all the way down there, guys, that would be consolidation of roughly 10, 12, 13% roughly. So if we do get down there, I will be looking to play Palantir. As of now, everything does still look good. We are still in control of this daily uptrend, still looking to set a daily higher low above 23.33, right? Daily higher low, further trend continuation, potentially furtherance of the weekly push. But if ever we lose 23.33, looking for extended consolidation, extended weekly pullback as well. 21.50 to be the target. It's been a substantially amazing run on Palantir so far, but I've always said, guys, keep a very close eye. $28, this whole region we're in right now, a lot of trapped equity from the IPO period. And then you also have a lot of people with substantial gains that accumulated positions here. May just be a big supply zone for Palantir. So going to be needing a lot of company specific news, in my opinion, to really propulse this higher than your $28 future resistance. And now lastly, PayPal. PayPal not doing too bad on the day, right? 1% to the downside. PayPal still battling within our zone here, guys. $60 to $57 is the area that I've said that we cannot lose, cannot close below here on the weekly, or we lose all the short-term structure here that we've built in pretty much the month of November. So PayPal still struggling here, still trying to set a little bit of a tightening range. We'll see how this one breaks, but the bears proving more resilient than not, right? Still below our moving averages, still below our downtrending channel line right here, which if we currently extend it right now, it's going to be roughly to the upside, right? About $62. So it's coming closer to us, but this as well as a company, it's going to need company specific news to really start juicing it to the upside. If it just follows the rest of the market participation, guys, and the market fails to go to new highs in terms of the indexes, well, you may just get a bit of a rollover here on PayPal. If that does happen, well, the bears will set the daily downtrend. They will also be capturing a crucial weekly uptrend as well, which is going to be very unfortunate for the stock at that point. If we do give that weekly trend back to the bears right here, we're battling. You can see no weekly closes below this $57 mark. If we do get one here, guys, safe to say that in the next area we're going to is roughly the $55 area of support, and then pretty much all the way down to $50. Unfortunately, it sucks to say, I know, as that would represent a little bit of a downside for PayPal, talking about 10-15%, but PayPal does move in the direction of the overall market. So far, no company specific news that could push it higher in the pipeline, right? Bit of a transition year for PayPal as a whole. So we'll see how this one goes. I do still like the stock. If it comes down to about 55, I'll be continuously making plays on it over the next few weeks. If I can get it lower than 55, it becomes a no-brainer play for me. Bulls playing some good defense here, guys, but what we really need to see is mount and close above this $60. Get us out of this zone down here. Get us back into the $61, $62 range where we have a better chance of really setting our weekly momentum to break this downtrending channel line to the upside. That is what we need. So that is pretty much everything I had for you guys. Now let's take a very brief look into my portfolio, and that'll be it. All right, guys, so taking a look at the portfolio, you can see that nothing changed, no new trades today. So just going to show you guys that all the positions that we wrote during the week now have all expired worthless. So we do still have those CSIQ 23.5 calls. Now that the shares have come down since yesterday, 23.50, I may just roll these down again on Monday and write the $23 calls. We really didn't get any additional, premium on these. Right, so we'll still be looking to maybe write the $23 calls for next week. Next week, maybe a little bit of a red week. So if we do come down here, that's what I'll be looking to roll down a little bit. If I can get 20, 25, 30 cents for the 23 calls, I'll be pretty much doing that. And all the rest here, guys, pretty self-explanatory. The CART, 23 puts, expired worthless. GDXJ, what we did since we did get assigned here, they're under 33, right? So we close at about 32, 38. We got 40 cents on premium. So our average cost is down. Right, let me just pull up the chart so it's easier. Average cost is going to be down to about $32.60. And what I chose to do towards the end of the day on the close, since the premium was there, I did choose to write the 33 calls already for next week. And we got 34 cents for those for about a 1%. So total average cost now going to be about 75 cents off of 33. So let's just put our average cost down here at about 32.26 rather. So you can see in just a couple of weeks, we've reduced our average cost fairly decently here, and it is a very nice area of support. Not nervous about this play whatsoever. So juicy premium on the puts this week and on the calls for next week as well. Wendy's ending pretty much worthless, closing above 1842. Apple as well, ending above 180, so ending worthless. Applied Materials short put 175s, also expiring worthless. Coinbase expiring worthless as well. I didn't close these manually, just let them expire worthless. Don't have to pay any commissions or any closing fees on these, so just let them expire worthless. Trade Desk as well. Trade Desk, we finally got called away. So we got called away at $71 here. So our total profit on Trade Desk here is pretty much $63.83 all the way up to about $71. So very juicy profit here, roughly $700 or roughly about 11.3%. That's fairly good here, guys. It's about a 1.5, 1.6% per week since being assigned on December 29th. I look to always make between 0.5% and 1% per week on anything that I get assigned. So that's been a very good trade as a whole. Happy that we just free up more buying power. So all these positions, mostly except for GDXJ and CSIQ, are going to be gone by next week. Now, the only trade that I manually closed was Google. So Google was trading roughly above the 142 at my strike price, trading above the 142, but at the end of the day, really tapered off below the $142 mark. I closed these manually, the trade that I did, right? So we had them for about 51 cents. I closed them for about 25 cents at the end of the day. I figured that rather than taking assignment, if Google continues to drop towards 141, 140, I'll just write more short puts. So we did capture, about 25 cents, $25 from these short puts. Just rather not be assigned yet, even though I like the price. If I can get an even better price into next week, that's what I'll be looking for. The Applied Materials 210 calls, I'm going to ride those a bit more. If we get a little bit of an uptick on Monday or Tuesday, I may just take profit on these. Unfortunately, did not take profit early in the morning, guys. These calls were sitting about $5. Maybe I should have, but I do still believe that we might still get a little bit of positivity in this, in the semiconductor niche. I'm looking for NVIDIA. Maybe there's going to be a little bit of a run up early week into NVIDIA earnings. Maybe if these can go back to about 205, 206, these calls should be about $4 or $5. So I'm probably going to take some profits when that hits as well. If not, it didn't cost me so much at all. So the stop loss right now for me is set pretty much at break even. Not going to lose a single penny on this trade. It's been decent so far, but maybe a little bit of a missed opportunity to take profit over the course of the morning this morning, but that's okay. Still like the stock, and we do potentially have a little bit of a run up for next week, but definitely going to be selling this one pretty much either before or NVIDIA earnings, depending on the price action. Now, moving on to TMF, still have that call right here, $40 call, still down a little bit on that. The Ethereum and Bitcoin positions are still active. TMF shares still active. Nike still not high enough for covered calls. Trade Desk disappears. BABA, we're still going to be writing BABA in the low $70 to high $60 range. Still want to average down on this position. Our average cost is around $78 right now, so pretty happy. CSIQ and my Canadian ETF banking shares. So everything pretty much good. We're ending the week very positively, generate about just over $1,200 in premium over the course of the week. Very happy. So next week, we're going to be looking to write a lot of positions since we now have pretty much full buying power on the account. So we'll be looking for some dips and trying to play big tech a little bit more aggressively. So hope you guys enjoyed the video. Hopefully it was helpful to you. If you did, consider dropping a like. I would really appreciate it. And consider subscribing to the channel if you are new as well. We would love to have you. Thank you so much to all over 700 subscribers of the channel. You guys really make this journey worthwhile, and it's been extremely fun so far. Hopefully I've been able to provide some good educational insight and also some trading insight that can help you for your own accounts. And if you have any questions, guys, always, whatever it is, if you want me to look at a stock, any earnings whatsoever, if you want me to look at some technical analysis, options, whatever you like, just drop it down in the questions, guys, in the comment section, and I'll be happy to answer you. I will answer in the format of what I would do personally for that position. So thanks very much for watching, guys. Have a beautiful weekend. Keep an eye. We'll be uploading a video as usual on Sunday for the top option plays for next week. So take care, guys, and peace.